Right now, $500,000 is a starter home, not luxury, not a dream home. Entry level. This is not inflation. This is a system failure. In 1990, average home price, $120,000 average income, $30,000, a 4 times ratio. Today, 2026, average home price, $420,000. Starter home, $500,000. Average income, $85,000. That's 6 times. Once housing exceeds 5 times income, it stops being affordable. It becomes exclusive. And the system doesn't shock you. It stretches you. Higher prices, larger loans, manageable payments. Until you're not buying a house, you're absorbing risk. Let's break the illusion. A $500,000 house, 20% down payment, $100,000 in cash. Average savings, $10,000. So most people are eliminated before the game even starts. But let's say you made it. You have the $100,000. Now, the real trap begins. Mortgage, $400,000. Rate, 6.8% monthly payment, $2,600. Looks fine. That's the bait. Because that's not the real number. Add property tax, 2.8%, $1,150 per month. Home insurance, $400 per month. Payments for maintenance of the area and infrastructure, $600 per month. Home repair and upkeep, $420 per month. Total, $5,170 per month. That's not ownership. That's a subscription. Now the ceiling. Banks look at how much of your income you spend on debts. Safe limit, 30%. To afford $5,170 per month, you need $200,000 per year. Average household income, $85,000. Even above average? Still not enough. So what is this? A market? No, it's a filter. And people don't leave the system. They stretch, put down less money up front, pay additional fees to the bank, take more risk. Because the system doesn't need you to win. It needs you in debt. And here's the key shift. This is not a housing crisis. This is a currency problem. Because houses didn't just become more expensive. Money became weaker. And until you see that, you will keep asking the wrong question. Not, why is housing so expensive? But, why can't my money keep up? So if housing isn't the problem, then what is? Money. Not how much you have, but what it's worth. Because over the last 20 years, money didn't just circulate, it multiplied. Let's go back. The system almost collapsed. Banks failing, markets freezing, credit disappearing overnight. So central banks stepped in, led by the Federal Reserve, and they made a decision. Print, not physically, digitally, quietly, massively. Trillions of dollars were created, injected into the system, to stabilize it. And it worked. But not how people think. It didn't fix the system, it inflated it. Because when you increase the supply of money, without increasing real productivity, you dilute value. Same goods, more dollars, higher prices. But here's the twist. That inflation didn't hit everything equally. It didn't go straight into groceries or gas. Not at first. It went into assets, stocks, bonds, and most importantly, housing. Because that's where money hides. Think about it. If you suddenly create trillion, where does it go? Into things that can store value. Things that are limited. And housing is the perfect target. You can't print land. You can't instantly build supply. And everyone needs a place to live. So capital flows there. Fast, aggressively, relentlessly. Now add the second wave, the pandemic. The system shuts down. Fear everywhere. Consumption drops. So once again, central banks respond. Even bigger, even faster. Stimulus checks, liquidity injections, near zero interest rates. Money becomes cheap, almost free. And when money is cheap, people borrow more. When people borrow more, they bid up assets. And when assets go up, everyone feels richer until they try to buy something real. Because now, prices have already adjusted. Housing took the hit. Hard. Between 2020 and 2024, home prices surged over 40% in many regions. Not because homes improved, but because money expanded. This is the part people miss. Prices didn't rise, currency fell, and housing just reflected it. Something else. Supply constraints, zoning restrictions, labor shortages, material costs. Builders couldn't keep up, even if they wanted to. So demand explodes, supply stays tight, prices go vertical, and suddenly, $500,000 becomes normal. Not because it should be, but because the system pushed it there. This is what currency debasement looks like. Not hyperinflation, not chaos, but slow, controlled asset inflation. The kind that feels like growth, but acts like a barrier. Because now the game has changed. Before, you earned money, then bought assets. Now, you must own assets to keep up with money. And if you don't, you fall behind. Even if you're working harder than ever. That's the real trap. Because wages move slowly, but assets move fast, and housing moves the fastest when money is weakest. So, when you look at a $500,000 house, you're not just seeing a price. You're seeing 15 years of monetary policy compressed into one number. And the worst part, it's not over. Because once the system depends on inflation, it can't stop. It can only slow down or accelerate. And either way, the burden shifts to you. So now you understand the setup. Money got weaker. Assets got inflated. Housing became the storage unit for excess liquidity. But this is where most people make the fatal mistake. They stop at the price, $500,000. They run it through a mortgage calculator. They see one number, $2,600 per month. And they think, I can manage that. That's not analysis. That's bait. Because the mortgage is the smallest honest number in the entire deal. Let's open the real ledger. Start again. $400,000 loan. 6.8% rate. Yes. $2,600 per month. But now we layer reality on top. Property tax, not optional, not fixed. In 2026, average 2.8%. But in many regions, it's rising faster than income. That's $14,000 per year, $1,150 per month. And here's the detail people ignore. Property taxes adjust. Your mortgage stays stable. Your taxes don't. So, over time, your fixed cost quietly inflates. Now, insurance. This used to be background noise. Now, it's a frontline expense. Climate volatility changed pricing models. Flood zones expand. Wildfire risk spreads. Storm damage increases. Insurance companies aren't guessing anymore. They're repricing aggressively. Average, $350 to $450 per month. But in high-risk areas, double that. And here's the catch. If your insurance spikes, your lender doesn't care. You still pay. Now, Homeowners Association. This is where modern housing hides municipal costs. Instead of cities maintaining infrastructure, they outsource it. To you. Landscaping, security, repairs, amenities you barely use. 2026 average, $600 per month. And rising, and no, you can't negotiate it. Now we reach the most underestimated line item. Maintenance. Roofs don't last forever. Heating, ventilation, and air conditioning systems fail. Pipes leak, appliances die. The rule? 1% of property value annually. For a $500,000 home, $5,000 per year, $420 per month. But reality? It's not linear. Some years, nothing. Then suddenly, $12,000 roof, $8,000 heating, ventilation, and air conditioning system, $3,000 plumbing issue. Maintenance doesn't bill you monthly, it ambushes you. Now let's stack it again. Mortgage, $2,600. Property tax, $1,150. Insurance, $400. Homeowners. Association, $600. Maintenance, $420. Total, $5,170 per month. That's the real cost, not the number in the ad. And here's where it gets more dangerous. None of this includes life. No food, no transportation, no healthcare, no investing, no margin for error. This is just the house. Now we talk about the hidden engine inside the payment. Interest. Because this is where the system extracts the most. That $400,000 loan, over 30 years at 6.8%, you don't pay back $400,000. You pay back $940,000. You bought one house, you paid for two. And the worst part? Timing. In the first 5 to 10 years, most of your payment is interest, meaning you're not building ownership. You're servicing debt. So if you sell early, you don't walk away with profit. You walk away with less than you expected, especially after fees, because selling a home isn't free. Agent commissions, 5 to 6%. Closing costs, 2 to 4%. Total exit cost, up to 10%. So your $500,000 home needs to become $550,000 just for you to break even. And that's before inflation. Now combine all of this. High monthly burn, slow equity build, expensive exit. This isn't just ownership, it's illiquidity. You're locked in. And if the market dips, you don't just lose paper value. You lose mobility. You can't move easily. You can't adapt quickly. You can't pivot. Your asset becomes a fixed obligation. And yet, people still rush in because the system doesn't show you this version. It shows you keys, smiles, congratulations, not spreadsheets, not long-term cost curves, not the total extraction over 30 years. Because if it did, you wouldn't call it a dream. You'd call it what it is. A long-term financial commitment with asymmetric risk. And most people enter it without seeing the full equation. Everyone thinks they can outsmart the system with timing. I'll wait for rates to drop. I'll refinance later. This is temporary. That belief is not strategy. It's dependency. Because interest rates are not a glitch in the system. They are the control mechanism of the system, largely influenced by institutions like the Federal Reserve. When rates were near zero, housing didn't become affordable. It became hyperinflated. Cheap money didn't help buyers. It empowered borrowing. And borrowing drives prices up. So when rates rise, people expect prices to fall. But here's the problem. Sellers don't want to sell into higher rates, and buyers can't afford higher payments. So the market freezes instead of correcting. This creates a deadlock. Low transactions, sticky prices, high monthly costs. That's the trap. And even if rates drop slightly, something else happens. Demand surges instantly. Everyone rushes back in. Prices spike again. You don't get relief. You get competition. So the idea that you'll wait for a better time assumes the system is designed to give you one. It isn't. It oscillates between expensive and unaffordable. Now let's break the refinance illusion. People say, I'll just refinance when rates drop. That assumes three things. Rates actually drop, you still qualify, and your home value holds or increases. Miss one of those and the strategy collapses. If rates stay high longer than expected, you're locked in. If your income changes, you don't qualify. If home prices stagnate or fall, you lose leverage. Refinancing is not a guarantee, it's an option, and options expire. Now look deeper at how interest really works. In the first years of your mortgage, most of your payment feeds interest, not principal. So when you refinance, you reset the clock. You go back to the beginning of the interest-heavy schedule. You feel relief in the monthly payment, but you extend the total extraction. You pay less per month, but more over time. This is how the system stretches you without you noticing. And here's the most important shift. Interest rates don't just affect your payment. They define your entire financial trajectory. A 2% difference in rate can change your total cost by hundreds of thousands of dollars. Not slightly, structurally. This is why the system doesn't need to trap you with price alone. It uses time, because the longer you stay in the system, the more you pay. And most people don't calculate total cost. They optimize for monthly survival. That's the weakness. That's what the system exploits. Now we move from numbers to behavior. Because the system doesn't just operate on math, it operates on belief. You've been told your entire life that owning a home is the goal. Stability, security, success. It's not just financial, it's emotional, cultural, social. And that's what makes the trap so effective. Because even when the math breaks, the belief stays intact. You see it everywhere. Social media posts. Just closed. So blessed. Homeowner at 25. Nobody posts the spreadsheet. Nobody posts the $5,000 monthly burn. Nobody posts the $900,000 total repayment. They post the keys, the kitchen, the illusion. And that illusion creates pressure. Not logical pressure. Social pressure. You feel behind. Even if the numbers don't make sense, you feel like you're missing out. That's how people rationalize bad decisions. They don't say, this is optimal. They say, this is normal. And normal is powerful. Now layer in rent psychology. Renting is framed as losing. You're throwing money away. But ownership at these levels isn't pure investing. It's leveraged exposure. You're not just buying an asset, you're taking on debt, illiquidity, maintenance risk, and market risk. Renting, in contrast, gives flexibility, predictability, optionality. But it lacks status, and the system knows that. Because status drives decisions more than spreadsheets. So people stretch. They overextend. They commit to decades of payments just to align with a narrative that may no longer be financially valid. And here's the deeper layer. Ownership locks you in behaviorally. Once you buy, you defend the decision. You ignore negative signals. You justify rising costs. You anchor your identity to the house. That reduces your ability to adapt, to move, to pivot careers, to take risks elsewhere. The house becomes more than a cost. It becomes a constraint. And this is where the system reaches peak efficiency. Because now you're not just financially committed, you're psychologically anchored. Question the system. You'll work harder to sustain it. And from the outside, it looks like success. But underneath, it's pressure. Continuous, compounding, invisible. Now we get to the part most people completely underestimate. You think you're competing with other families, other buyers, people just like you? You're not. You're competing with capital. Institutional capital. Firms like BlackRock, Blackstone, and Invitation Homes don't look at housing the way you do. You see a home. They see a yield curve. You see a place to live. They see a cash-flowing asset with inflation protection. And most importantly, they don't need mortgages. They deploy cash or access capital at a cost you will never get. That alone changes the game. Because when you walk into a deal with a loan approval, you come with conditions, timelines, risk checks. They come with certainty. Fast closes. No contingencies. Sellers prefer them. Algorithms support them. Entire neighborhoods get absorbed by them. And this isn't theory. This has already happened in multiple markets. Institutional ownership of single-family homes has been rising steadily, and in certain regions, they control a meaningful percentage of inventory. That reduces supply for individuals and increases price pressure structurally. But it gets deeper, because they don't just buy homes. They transform the model. They convert ownership markets into rental ecosystems. They normalize long-term renting. They standardize rent increases. They optimize maintenance costs at scale. And slowly, quietly, they turn housing into infrastructure. Not shelter. Not a milestone. Infrastructure. And once something becomes infrastructure, it becomes controlled. Now think about what that means for you. You're not just trying to afford a house. You're trying to enter a market where your competitor has more data, more capital, more patience, and zero emotional bias. They don't fall in love with a kitchen. They don't overbid because of fear. They execute strategy, and strategy beats emotion every time. This is why you'll hear stories of people losing bids repeatedly, offering above asking, waiving inspections beyond comfort. That's not bad luck. That's structural disadvantage. You're playing a game that has already been scaled beyond your level. And here's the key insight. Institutions don't need prices to drop. They need volatility. They need access. They need individuals to hesitate. Because every moment you step back, they step in. Every time rates spike and retail buyers freeze, institutions accumulate. This is not a fair fight. It's not meant to be. It's a transition from individual ownership dominance to institutional control. And if you don't see that shift, you'll keep playing by rules that no longer apply. So now we arrive at the only question that actually matters. Not, can you afford a $500,000 house? But, should you even try? Because affordability is no longer just about income. It's about positioning, strategy, timing, and most importantly, understanding the system you're entering. The old model was simple. Work, save, buy a home, build equity, retire. That model worked when prices were low, debt was manageable, and asset inflation hadn't detached from wages. That world is gone. Completely. And pretending it still exists is financially dangerous. Today, buying a home at $500,000 with high rates, high taxes, and high maintenance isn't automatically wealth building. It's leveraged exposure to a volatile system. That doesn't mean it's always wrong. It means it's conditional. Highly conditional. If you have stable high income, long-term time horizon, and margin for error, it can still work. But if you're stretching, relying on future rate cuts, or assuming appreciation will save you, you're not investing. You're speculating. And the system punishes speculation over long timelines. So, what's the alternative? You shift your framework. You stop seeing home ownership as a default goal and start seeing it as one option among many. You prioritize liquidity because liquidity gives you power. You prioritize cash flow because cash flow gives you resilience. You build assets that are not locked, not illiquid, not dependent on one geographic market. That could be businesses, digital income streams, market investments, anything that moves with the system instead of being trapped inside it. Because the real game in 2026 isn't ownership. It's adaptability. The people who win are not the ones who follow the old script. They're the ones who understand the new rules early and position accordingly. That might mean renting longer. That might mean buying differently. Multifamily, income-generating, unconventional plays. That might mean not buying at all. Most people struggle with, walking away from a narrative they've been sold their entire life. But here's the truth. The system doesn't reward tradition. It rewards awareness. So the final verdict is simple. A $500,000 house in 2026 is not just a purchase, it's a commitment to a financial structure that will shape your next 30 years. If you understand that structure and it fits your strategy, play the game. If you don't force it. Because the biggest financial mistake now isn't missing out. It's locking yourself into something you don't fully understand. And in this system, clarity is worth more than ownership.